The key difference between your balanced advantage fund and the aggressive fund what you manage at the Sundaram Asset Management Company?
Okay, so I think when you look at any investor who walks into equities, there are a few questions which he grapples with, right? What to buy, when to buy, and how much to buy. And especially when it comes to the decision of how much to buy, you need a scientific process of managing the ups and downs in the equity markets. So BAF, as we call for a balanced advantage product, is a category where we take out the allocation risk from the investor. So what does the product do? When the money is parked with a balanced advantage fund, the fund is invested into equities based on an investment framework, and what at Sundaram we do is we follow a trailing 12-month PE as a framework to allocate the amount between fixed income and equities in a dynamic fashion. So when the variable moves every month, we rebalance equities accordingly so that the allocation risk for the investor is taken away very clearly. On the contrary, what does an aggressive hybrid fund do? Aggressive hybrid fund is a static allocation product where typically we, for example, we work with a 70-75% equity allocation as a standard framework, and 20-25% is earmarked as debt. So the whole difference here is in terms of allocation risk being taken away. The second part is when markets provide opportunities at extremes of either euphoric or pessimistic nature, BAF as a category enables the fund manager to size up on those opportunities and make use of those drawdowns or excessive optimism and adjust the equity allocations accordingly. So over a 3-5 year period, all these even out. But in the short run, if it's about managing risk and volatility, BAF has a slight advantage over aggressive hybrid product. But as I said earlier, in the medium term, both converge given the nature of playing two asset classes at the same time, but with slight difference in terms of allocation. So the key message is in terms of how the investors' drawdowns are managed and how the allocation risk is being taken away from the investor.
Got that. When you say that there is a trailing 12-month PE, is this a proprietary model what you follow at a company?
So it's an in-house framework. Every fund house would have its own framework. What we have been used to do using this framework is that earnings pick up the signals of the investor's emotions very quickly. Unlike most of the other variables, a PE framework tends to reflect the investor's emotions much more quickly, and most of the discounting happens in the price as soon as the results are out. So what we try to look at is a trailing 12-month framework in which the last 4-quarter earnings are taken, adjusted for all the non-recurring items, and when measured against the market prices, you get to know whether the markets are in a zone of typically where they used to be in the last 5 years, or are we hitting any extremes in terms of these valuations. And based on that signal, the immediate month rebalancing of equities happen in the BAF product. So it's about how quick we are to respond to market signals, and in that perspective, a PE is something is as close as possible compared to some of the other variables in the market. It's more about responsiveness to the signals that we get.
Okay. And how dynamic is your balanced advantage fund compared to other funds in the peer group industry?
Okay, so each one has its own way of approaching market signals. We rigidly follow a trailing 12-month PE framework, and what we do is that it's a monthly rebalancing that we do. So based on every month average PE of the market, which includes adjusted earnings for all the non-recurring items, we try to see if the market valuations are in sync with the past averages. So what do we mean by past averages? We look at the last cycle market averages, and what it shows is that if there are extremes in the market in terms of PE, and when we plot it against the past averages, we get some signals whether we are one standard deviation above or one standard below the market averages. So in our experience, typically 60-70% of the time market used to trade closer to its past cycle averages, and it's in the 30% of the occasions where investors need to be cautious in terms of allocation. Okay. If we address that to the most closest extent possible, you get your allocation call right. So that's the simple framework that we have and which we use diligently. And the other advantage, as I told you, is that by using a trailing 12-month PE, you're getting as close as possible in picking up the earnings signal and the price signal quickly. So this is slightly different compared to some of the other practices where people do use GDP, market cap to GDP,
yes,
and then your price to book and all, which again, each one has its own impact in terms of timeliness and the cycles at which it refers to. From our perspective, the testing of PE has been far more handy in picking the extreme signals more closely. So that's why we stick with